Now we will evaluate return on investment ratio, okay, or return on investment chart, okay. So return on investment ratio or return on investment chart, okay. So what is the return on investment? Return on investment is equal to return upon capital employed into 100, okay. Now say if we multiply and divide this formula by sales, okay, sales and sales, now it gets bifurcated into two formulas, okay. So what are those two formulas? One is return upon sales into 100. So this is what, this is profitability ratio, okay. Then the next is sales upon capital employed. So sales upon capital employed, if you see carefully, what is that? That is a capital turnover ratio, okay. So basically return on investment depends on your profitability ratio and the capital turnover ratio, okay. Now this profitability ratio can again be bifurcated into your gross profit ratio, right? On the basis of profitability, it can be bifurcated into gross profit ratio. Then you have net profit ratio, operating profit ratio. So what is a gross profit ratio? Gross profit ratio is gross profit upon sales into 100. This is what net profit upon sales into 100. Operating profit is what? Operating profit upon sales into 100, okay. Now this gross profit and net profit ratio, to evaluate this gross profit and net profit ratio, what can we do is we can just evaluate this ratio based on various expenses like materials consumed upon sales into 100, okay. Then we have wages upon sales into 100, okay. Then we have manufacturing expenses upon sales into 100, okay. Then now if we evaluate this three, that is manufacturing expenses, wages and material consumed, we'll understand why our gross profit is higher or lower. Then for net profit analysis, what we can do is, say if the industry standard gross profit margin and our firm's gross profit margin is same, we can evaluate your net profit. How can we evaluate your net profit? Manufacturing expenses upon sales into 100, okay. Administrative expenses upon sales into 100. Selling and distribution expenses upon sales into 100, okay. This is how we can evaluate your net profit, okay. Then there is other way in which we can evaluate our expenses, okay. This was about net profit. Now there is one more way. What we can do is we can find out fixed expenses upon sales into 100. Then variable expenses upon sales into 100, okay. So this is how you can evaluate your profitability ratio. Now coming to your capital turnover ratio. So capital turnover ratio is basically, you can evaluate it into two types, It's basic bifurcated into two types. So capital turnover ratio comprises of your fixed assets turnover ratio. Okay, so what is a fixed asset turnover ratio? Sales upon fixed assets. Okay, so in this also fixed assets, we can find out fixed asset turnover ratio for each individual fixed asset, that is say furniture and fixtures, then your plant and machinery, okay, land and building, like that. Then you have working capital turnover ratio. Okay, so that is sales upon working capital, right? So this working capital, if you see, it's again bifurcated into various types of other ratios. Okay, I'll put it here one by one since there is a space constraint. Okay, so one is what? Inventory turnover ratio, right? Then your debtors turnover ratio, right? And one is your creditors turnover ratio. Okay, so this is how you evaluate your working capital. So if you see this return on investment, once you find out that, you can bifurcate that return on investment into two: profitability ratio and capital turnover ratio. And then for each and every profitability ratio there is a component like gross profit, net profit, operating profit. Okay, so you can find out all these ratios, compare it with the industry standard, and evaluate how your business is performing. And if some ratio is higher or lower, you can just evaluate it further to understand what is high or what is low. Okay, or what is the reason for a particular ratio being higher or lower as compared to the industry standard. Okay, so this was evaluation of return on investment ratios. Thank you.